at these times, politically and economically, I think we're all somewhat confused, and it's pretty good to have a beacon, somebody who can take all of this stuff, and I think of Professor Leiderman as a translation machine. He can take a lot of data and kind of condense it into a worldview that I think we'll all find to be amazing. I'm going to introduce him in just a few minutes. I did want to take an opportunity, though, to give you the perspective as we see it before the professor comes on, and I'll give you some insights that our team over here at RVW Investing, and hopefully this information will be helpful and useful to you as well as you try to navigate what are clearly choppy waters with a lot of headwinds and very difficult to predict. So with all of that, let me first of all welcome everybody, thank Tel Aviv University, and thank you all for coming. There are some people who are stuck on the freeway. We've been receiving emails and texts frantically from a few people saying we're trying to get there. And I said we'll hold it. We've held it already, and I'll take a little longer than I otherwise would have. We're hoping to get the professor on at about 8:20, so I'll have about 15 or 20 minutes to take you through things as we see them, and maybe to have a brief discussion before he comes on. First of all, I thought it would be a good idea just to take a look at the wild cards, the things that could go wrong, or the things that could go right going forward. And it's as well just to be aware of what's out there before we actually come to some conclusions and derive a strategy. Now, first of all, what could go right? The first thing that could go right is job growth could improve. We are currently on track to create 2 to 3 million jobs in 2011. Unemployment is currently looking like it could fall to around 9%. That's not a prediction, it's a possibility. That would be good news. And here's the supporting data to support that. Initial jobless claims are trending down. You can see that. Jobless claims are trending down. You can see that over here through the beginning of 2011. And you can see over here that payrolls have started to recover, and there's more good news this morning on that. So it's possible. There's no predictions over here. We know from the Bible, prophecy was given to fools and crazies. Hopefully I'm neither. So we're not in the prediction business, we're in the strategy business, but we need to understand the data that's lying there. So this is a possibility. This could go on. Next thing that could go wrong, business and consumer sentiment could continue to improve, and with that, valuations of companies will continue to improve. Take a look at some data to support that. Here's the data. Personal consumption expenditure bouncing up and predicted to continue to rebound. Personal saving rates. Now, that's a very important thing because the United States consumer was basically bankrupt as a result of their home equity and their retirement assets and so on having gone, and we were actually in what was called negative savings, which is something that my late mother would never have understood. And in America, could they invent a word like that, negative savings? We were in that for a few years, and you can see it when we had these kind of savings rates over here, so low. Most people were in a negative savings rate position. Well, the consumer was forced to rebuild his or her balance sheet through a cutback in consumption and so on. And we're seeing now the beginning of the rebuilding of balance sheets as saving rates have gone up and as consumption has improved, and that could continue. Next, earnings could continue to exceed expectations. We think that the S&P 500 will earn about $90 a share. That's about a 15% increase on last year, and pretty bullish. If the rise in large company earnings, and we'll come back to that, continues, that would be a really good thing for everything. People's retirements would be reinstated, the equity markets would move up, the environment, the mental sense, the spending patterns, would be really good to see earnings of the large companies go up. And as you'll see a little bit, I'll tell you why that could, and we think probably will happen. People could move from bonds to stocks. That would be very bullish for the stock market. Now, those of you who are reinvesting your money in bonds know that you earn, as they say in French, garnished mid garnished. I mean, there's nothing today in bonds. And as Warren Buffett said today in an interview on MSNBC, he detests bonds. For many reasons. There are good reasons why all of us should detest bonds. They have a role in a portfolio, but clearly there are huge limitations with bonds, and I'm going to show you in a minute some of those limitations. Well, if people get back into equities, in anything remotely like what's a historical pattern of ownership, we could see a real move from equities to equities from bonds. In particular, the large dividend-paying companies. There are great companies out there paying huge dividends that are taxed favorably, by the way, and you have the upside of large companies. Just one example, Johnson & Johnson. Their bonds are currently yielding about 3.5%, and their dividend yield is about the same. Well, you could choose which one you want. The bond yield is fully taxed with no potential for growth, really, and the dividend yield, as far as we're concerned, is rock solid, well covered by earnings, likely to appreciate over time for reasons that I'm about to get into when we get to what I want to talk about, which is the the global gorillas, the large, huge multinationals, which is where we think the game is, and we'll tell you about that in just a moment. But if there is, in fact, a trend to move from bonds to equities as the baby boomers begin to retire, realize that their social security income is woefully inadequate, and begin to see where they're going to place their money, equities might be a very attractive place to go. Next, what could go wrong? Plenty could go wrong. First of all, credit problems could resurface. We could have a housing problem, a sovereign debt problem, state and local issues, etc. Any of those, what we call the wild cards in a negative sense, this could be pretty bad if we had one of these collapses. By the way, one of these also, and you'll see in a minute, is commodity prices could increase. Now, I prepared this well before the most recent surge in oil, and I actually did a special slide on that. But in general, commodity prices have gone up tremendously. By the way, not least because of the US's obsession with the production of ethanol. Ethanol consumes 40% of our corn production. Now, for those of you tree huggers out there, you realize the huge negative problem that causes. It happens that that amount of corn could feed 350 million people for a year. So we take corn away from 350 million people every year because we need to produce oil. I'm not going to get into political discussion. It just makes no sense economically. And of course, there are other problems with it, but not for now, for another time. But nevertheless, and that, by the way, if you're a real skeptic, could be one of the reasons why Egypt collapsed, because the rising food prices were one of the reasons that Egypt collapsed. And one of the reasons why food prices have risen is because when you remove this quantity of corn from the market, what you basically do is there are lots of substitutions going on, and it's a huge fungible market. Another talk for another time, just a skeptic's view. Here's another one that could go wrong. Interest rates could rise more than expected and could choke off the recovery. Next, currency and capital flows. Bear in mind that we could have a currency war with China. Not impossible, not impossible. And any of those would be really bad. Oh, sorry. That's it. Yeah, I think I pushed.
It's good. This is good.
Okay, sorry. Okay, yeah, here there are two real big wild cards, and I wanted to tell you what they are. Number one, the price of oil. 4 of the 5 past recessions were accompanied by spikes in oil prices, and if oil continues to go up, that will be really bad for us. And the other wild card, of course, is, you don't know what you don't know. The black swans out there. The things that we can predict are far easier to cope with, but the things that we didn't even know were around, the things you don't know that you don't know. So the black swan, and those of you who don't know what the black swan is, it's the unknown. Now, I want to talk briefly about what we do and how we cope with that. Just briefly how we do things. First of all, we know the following. So we're the kind of anti-Wall Street, if you will. Number one, we know that 80% of managers fail to beat their benchmark indexes. I mean, if you just bought the S&P 500 or the Dow Jones, you'd beat 80% of managers over any 10-year period. That's the first building block. So we have zero respect for the Wall Street machine. Self-serving, self-interested, doesn't have a fiduciary duty, and so on. Next, stock picking and market timing don't work. Next, and we know that, and I'm going to demonstrate that briefly. Next, you need to have stuff that's transparent and you understand exactly what your portfolio holds. Most people don't have any idea what they're invested in or why. Next, asset allocation. This is Nobel Prize winning economics, nothing original, by the way. Asset allocation is the primary determinant of returns. How you deploy your money is more important than picking the right stocks, because picking the right stocks is basically, for most people, most of the time, impossible. Next, although the last decade was a lost decade for large company stocks, in fact, for those who own international, emerging markets, and mid and small cap stocks, they actually did quite well. So don't believe the headlines. There's a whole article which I'm going to give you over here called "The Last Decade Was Not the Lost Decade." I just finished it last night. I think you'll find it to be interesting. Next, minimizing costs and taxes are critical. If you incur heavy costs and heavy taxes, you'll never get ahead of the game. The headwinds will just put you on the treadmill. And finally, bond funds are in many cases a time bomb, which will go off mathematically as interest rates rise, which they ultimately must. Let's take a look at what's the thinking behind this and see how we derive our approach. First of all, here's the case against bonds long term or for stocks. If you put $1 into equities in 1926 and you go back through the end of 2010 and you did absolutely nothing, zero, garnished, you resisted the impulse to respond to your gut, which will always lead you astray, by the way, in this area. If you did nothing, despite severe turbulence in the 1929-1933 crash, your $1 in small stocks ended up being $16,000 at the end of 2010 if you did nothing. That's the key. Most people have to discipline themselves because they keep having the urge to do something. Large cap stocks came up to $2,900. Now take a look at bonds, and I've got many slides on this, but I want to show you. If you take a look at government bonds, treasury bills, relative to inflation, you will see that the return on most bonds paled in insignificance compared to equities. That's the problem. So the long term is really good for equities and really bad for bonds. The only reason for bonds is in these times over here, bonds tend to retain their value. So we'll get back to that, but Warren Buffett is not a fool. We agree with him long term. The other thing you need to know is, and this is part of the education, don't be afraid of the bear market. The big bad bear is only scary to little children. To sophisticated investors, we know about the big bad bear, and this is what happens. After 1 month, 6 months, 1 year, 3 years, and 5 years from a major collapse. And take a look at all the collapses. October 87 stock market, August 89 savings and loan. Long-term capital management, 1998, people don't even remember that anymore. The dot-com crash, the terrorist attack, the banking crisis. Every single one of the major collapses over the last several decades has been analyzed, and you'll see what happens after 1 month, 6 months, 1 year, 3 years, and 5 years. And you'll see where we are right now over here. We're 3 years out. Okay, you can see that, we're 1 year out. You can imagine, based on this, that it's very likely that the navy blue and the light blue are likely to go up over this period. Not necessarily, but if you look at the trend, you'll see that as you look 5 years out from a catastrophic event, and all of these were catastrophic events, you see the stock market significantly higher. Now this doesn't include 100% equities. This is a 60-40, which is a relatively classic allocation. And you see that 5 years out, you're pretty far ahead. So that's the case for optimism, if one can be optimistic. Now here's what we actually did in our equity portfolios. For 2010, we actually did 18.4% net. And if you were in our model portfolio for all of 2009, you actually made 32%, and we'll talk about how we did that in just a moment. Use 11 ETFs, over 5,000 great companies, including an allocation to gold and to water for another time. Just briefly, here are the elements of portfolio design. Number one, asset allocation is the primary determinant of portfolio performance. Number two, top-down orientation. Don't think that people can go out to China or India or Brazil and sniff out some great new company. It's not going to happen. You don't have the muzzle to find the next Apple. And if you do, you should be buying lottery tickets because your odds are probably better. Top-down means you start off with asset allocation. How much do you want in large stocks? How much do you want in small stocks? How much do you want in value? How much do you want in technology? How much do you want in emerging markets? How much do you want in established markets? And so on. That's top-down. And then low costs. We're all tightwads because we've got 2,000 years of buying wholesale. Paying retail for investments violates the essential Jewish principles. We believe in buying basically wholesale, and our clients do. We also believe in saving income taxes, and we do that because we're all CPAs, and wasting money in these two areas of costs is just pathetic. And finally, everything should be simple and transparent. If you don't really understand what you have and why you have it, fire your wealth manager, because nothing is complicated. Let me just breeze on here with some other stuff. Now, let's talk about the impact on taxes very quickly, and you'll see the huge difference between stocks after taxes, bond income after taxes, etc. And you'll see that these amounts compound significantly over long periods of time and make a huge difference to your overall wealth. Here are the mistakes that people make, which is why most people are afraid of equities, and there's no reason to be afraid. Here are the mistakes people make. Market timing, which doesn't work. Stock picking, which doesn't work. Buying yesterday's winner, everybody does that. What worked yesterday will almost always not work tomorrow. And finally, excessive fees and charges charged by the Wall Street machine, most of which are never disclosed. Now, just take a look and see what happens if you miss the best month, okay, in every one of these years. Just take a look and see in the whole year, in your annual return, just take a look at that. That over there, right, was the annual return at the top. And if you missed out the best month, you missed out the dark green. Just take a look at the huge impact that missing 1 month out of a whole year can do to your returns. It's quite spectacular. Take a look at the next one. Look at a dollar invested from 1991 to 2010. That's a 20-year period. If you did nothing, your dollar grew to 5.75. If you decided to miss the best 13 months, you only got $1.96, which is your treasury bill rate. Just, you were in for the whole 20-year period, except for the best 13 months, you blew it. Take a look at another example, and you'll see it over here. We did a micro-analysis from 94 to 2004. If you did absolutely nothing with $10,000 and just left it in a large cap index, your 10,000 grew to 26. If you missed the best 10 days, 16, 20 trading days, 11, and here's the worst one, if you missed the best 30 trading days out of 10 years, you didn't even get your money back. That's what most people do when they drive, when they do their portfolios, of course. It's like driving down a rearview mirror. Now, if you look at the asset classes, and these are the major allocations, best to worst, you'll see what's called style rotation. Every one of these has a moment of glory in the sun. If you think you know which is going to be the one for next year, then we'll put all our money with you, but you don't. And there's no way to tell. And if you drive down the road looking in the rearview mirror, pick any one of these colors and you'll see that they all have a moment up there and a moment of devastation. So this is why stock picking and prediction just simply is good for tarot card readers. Now here's a respected publication, Smart Money, part of the Wall Street Journal publication. Every month they pick a company and they have two Wall Street experts telling you why it's bullish and bearish respectively. So here you have one of these Wall Street types telling you, yes, Caterpillar is very good, you should buy it, gives you 4 wonderful reasons. Here's an equally genius, well-trained, credible, reliable resource telling you no, you should get out, and here's why. So here's another example from Fortune magazine. This is the game we're not part of and suggest you not be part of either. Here's Fortune magazine, one genius is telling you get into Ford, it's a good company, and here's why. And here's a bear from no less than Credit Suisse telling you why you should get out. We rest our case. Prediction does not work. What do we not do? This is what we do not believe in. All of these things. None of them work. Just a little more of the data. How other people sell you bonds. When you buy bonds from your stockbroker, they generally do not act as brokers. Calling themselves a broker is a misnomer. They actually act as a principal. They buy the bond from a fool like me who didn't know what to sell it for, to a fool like you who doesn't know what to pay for it. And they make an undisclosed, undiscoverable margin. They do not act as a broker. Calling themselves a broker is a misnomer. That's why you hear that word less and less. Even though they pretend to be brokers, they're actually merchants buying and selling bonds and other products. The only workplace they act as brokers, true brokers, is in the equities, where they actually sell you the stuff. Now, let's talk about where we think the future lies, having told you everything. We're overweighted in what we call the global gorillas. These are the huge global brands, and I'm going to deal with some of them just now, and here's why. They have huge cash reserves. The S&P 500 as a group has $2 trillion in the bank right now. Unprecedented. Number 2, they have a global economic footprint. As the dollar falls, you have currency diversification, economic diversification. They can withstand the headwinds because of their size and their muscle and their power in the market. They are busy doing outsourcing and cost cutting, which is why they're making a fortune. Technology has helped these people tremendously. The profits are growing in the large companies. Don't confuse these large companies with your neighborhood strip center, which is half empty, or your little store, your gift shop, or your Hallmark gift shop, your plastic surgeon who you know who's in trouble, the small businesses, small real estate owners. There are two worlds right now. As Dickens said, the best of times and the worst of times. If you're in this category, it's the best of times. You can borrow at the lowest price in history virtually. You can issue shares at very high prices and so on. Access to emerging markets, just 2 examples. Walmart just bought the largest equivalent company in Southern Africa called Massmart. So if you want to be in emerging markets, you can just own Walmart and you'll have your share of Southern Africa. Pepsi-Cola just bought the largest dairy and beverage distribution company in Russia called Wimbledon for $4.3 billion, for which they wrote a check, by the way. So if you want access to Russia, you can just own Pepsi. You don't have to go and sniff out some great company in the emerging markets. Most of them, or many of them, pay very attractive dividends, and you also, obviously, as I've said, have currency diversification. So those are important. Now, these are the major global brands. We own all of these, we believe in them. You see that very few of them are actually US-based companies, even though they're all global. Now, let's just talk about how we access them, because I think this is important. Cap-weighted indexing. I've already told you that indexing on its own beats 80% of active managers, just if you just bought a major index. But what can you do to enhance that? There are problems with cap-weighted indexing. They're overweight, the overpriced, and in favor. Definitionally, the article is here. You'll be able to read it. But they simply do, because they allocate your interest in their index based on the capitalization of the company. So the higher the market capitalization, because the price of the shares has gone up, the more you have allocated to that company, obviously. So just to give you a sense of that distortion in the S&P 500, we calculate that right now about 50% of your money would go into the largest 50 companies out of 500. And the smallest 50 companies out of 500 would have under 2% of your money. So you're not really well diversified among the 500 companies. So it's distorted by market volatility also, over-concentration, and you have alternatives, the equal weighted index and other enhanced indexing, which we incorporate. Just to give you a sense of that, not all indexes are created equal. So just to give you a track, from the middle of 2009 to the middle of 2010, we micro-tracked 3 indexes. PRF, which is a fundamentally weighted index, Dow Jones Industrial, and the S&P. And you'll see that if you didn't know better and your broker delivered a 25% return over that year period, you'd think he was doing great. Not knowing there's something called Power Shares, PRF, that actually delivered about 39% over the same period, because it does its allocation and its weighting differently. Here's another example. Here are 3 indexes. This is the S&P 500. That's the equal weighted S&P 500, and that's an ETF that calculates differently. I don't want to get into that right now. It's another whole presentation. But you will see that the Standard & Poor's did about 40% over this period, which is 2009 to 2010, a 2-year period. S&P did 40%. You will see that the equal weighted did about 75%, and the PRFZ did about 110%. So the large indexes can be improved upon. The next thing is we believe in diversifying over time. We do not want to be in the timing business, we want to be in the strategic business, and these are all things we recommend to you. So getting into the market should be done over a period of time in a staged way. Getting out of the market should be done in a staged way. And bonds should also be laddered, and if you don't know what that is, read about it in my new book, by the way, which has just been edited and is going to come out, called The Wealth Blueprint. You'll all get a copy. Here are the major mental images that you need to keep in mind if you're going to be in equities at all. The market is like a man walking up the stairs with a yo-yo in his hand. You've got to watch the feet and not the hand or the yo-yo. Very important mental image, particularly when markets collapse. This is William J. Bernstein, and pretty much reflects our view of the brokerage community, what we call the red light district of Wall Street. Results do speak louder than words, and that's how we did it. Thank you so much for your time. I'm now going to I'm going to pass out these handouts for you to study. I think you'll find them somewhat useful and interesting. And I think it's now time to invite Professor Leiderman to join us. Professor, are you there? Hold on,
let's hope that works.
Can you hear me? Oh, we can hear you. Perfect. Thank you. Can you hear me?
Yes, I can.
Fantastic. Thank you. Professor, we're going to move you onto the screen now so that everybody can see you. Ah, great. Thank you so much. Let me introduce you, and then it'll be over to you. It gives me, and all of us here at RVW and Gerber and Company, and of course, on behalf of the Tel Aviv University, with whom we are honored to be partnering today, truly honored, to welcome Professor Leonardo Leiderman to speak to us today. I fell in love with Professor Leiderman when I heard him at a recent Tel Aviv University event, and as soon as he'd finished, I said, we've got to have you on at our conference room. I didn't let him out of my sight until we fixed the date and fixed the time, and here we are. Professor Leiderman is the Chief Economic Advisor of Bank Hapoalim, and by the way, the American banks have much to learn from the Israeli banks. The leading commercial bank in Israel, Tel Aviv University, holds the Chair of Comparative Economics and heads the interdisciplinary Pinchas Sapir Center for Development. He's an Argentinian native, so we're all southern hemisphere people, he and I and some of us. And university academic at the University of Chicago, Boston University, International Monetary Fund, World Bank, the Inter-American Development Bank, and has also consulted with central banks and ministries of finance around the world, including Argentina, Brazil, Colombia, Mexico, and Turkey. He's the author of more than 70 articles, professional books, journals, and has edited 7 books. It gives me much pleasure and honor to welcome you, Professor. It's over to you. Thank you so much.
Thank you very much, Selwyn. Can you hear me well?
Very well.
Okay, thank you very much. So thanks to all of you for attending this early morning meeting. For me, this is the end of the day, so from here I go home. I'm in my office at the Tel Aviv University, and it's a great opportunity to share with you some of our views on some of the exciting and sometimes nerve-breaking developments in this area. I'm not an expert in the Middle East, but I'm a professor of economics here, as you know, but of course things are related, and as we heard in the previous presentation, the whole issue of the price of oil and developments in the Middle East are going to be quite crucial for the months and maybe years ahead. So what I would like to do is to share with you some comments on 5 main topics. The first one is to discuss a little bit what we see the current situation, especially in the MENA region, Middle East and North Africa. Second, to talk a little bit about developments in the US and what is likely to be the impact on the world economy of the current developments that we are seeing. The third topic is to focus a little more on the US economic situation, and then to turn a little bit to Europe, and finally to discuss very briefly some implications for the investor. I think if I had to give a title for this mini presentation, it would be that we are at a time of a major transition to the unknown. In all the areas that I mentioned before, I think the key word is transition. We know pretty much where we were. We know everything is moving in a very fundamental and strong way. The changes that we are seeing, can you see me?
Yes.
Okay, because for a second I was not able to see you. The changes we are seeing in the Middle East,